Have you ever felt like you'd need a secret decoder ring just to understand, like, what's actually happening with the company's finances?
Oh, absolutely.
Like, I know I've definitely been in situations where someone starts talking about financial statements and it's like my eyes just glaze over.
Yeah.
And I think a lot of people probably feel that way, Like, you want to be able to quickly understand the financial health of a business, to understand the story that the numbers are actually telling.
Right.
And that's actually what we're diving into today.
Absolutely.
Think of this as your express route to, like, understanding the essentials.
This deep dive is all about really the bedrock of business financial accounting.
Yeah.
And the key documents that help to reveal, a company's financial story, which are its financial statements. We're going to equip you with a practical understanding of these fundamental concepts.
And our mission here is really straightforward. We just want to cut through the complexity, right? We want you to come out of this conversation really understanding what these statements are, why they're so crucial, and how they all fit together. No getting lost in the weeds or anything.
Yeah, just the core knowledge.
It's just the core knowledge.
The need to know.
Yeah, exactly.
So the foundation for our deep dive today comes from the chapter titled The Financial Statements in Financial Accounting, 12th edition, by Thomas, Tietz, and Harrison. It's a widely respected resource that's used in educational settings to give a strong initial understanding of this really vital subject.
Okay, so let's just get right to it. Why is understanding accounting so important in the first place?
Well, think of it this way. Accounting is often referred to as the language of business. And just like you need to understand language to follow a conversation or read a book, you need to understand accounting to really grasp how a business operates, how it makes decisions, and how it performs over time.
So it's like more than just keeping track of money coming in and money going out.
Exactly, yeah. There's a real distinction between bookkeeping and accounting. Bookkeeping is largely the mechanical task of recording financial transactions.
Okay.
Accounting takes that raw data, then interprets it, summarizes it, and communicates it through those financial reports that we're focused on. It's the analysis and the interpretation that provides that real understanding.
Right, so there's a whole process there of taking those basic transactions and turning them into something meaningful.
Exactly. So if you look at Exhibit 1.1 in the text, it illustrates this process.
Okay.
And it starts with the day-to-day business activities. A sale is made, inventory is purchased, employees are paid. These individual transactions are then systematically processed and ultimately summarized into those financial statements and reports.
Okay.
And these reports are what various people rely on to make informed decisions about the business.
So who are these people? Who is making these decisions based on this information?
Well, that's a great question. There are generally two main branches of accounting that serve different needs. We have financial accounting and managerial accounting. Today, we're going to be focusing on financial accounting,
Okay.
which is designed for those outside of the company.
So people like investors who are trying to decide where to put their money, or banks who are trying to decide whether or not to approve a loan.
Exactly. Investors want to assess if a company is profitable, if it's risky, and if their investment is likely to provide a good return. Creditors, such as banks, need to evaluate a company's creditworthiness, their ability to repay borrowed funds, before they issue that loan.
Okay.
Regulatory bodies might also use this information for compliance purposes. And even the general public can be interested in the financial health of companies they interact with.
Okay, so the managerial accounting is more for the folks inside the company.
Yes, managerial accounting provides information that is tailored specifically for internal users. This is the management team within the company. They use this information for creating budgets, forecasting future performance, and making strategic operational decisions.
So, like, think about a company like Disney.
Sure.
Their managers are using this managerial accounting data to help them decide everything from which new movies to produce to, like, how to price tickets at their parks.
Yeah, or which product lines are most profitable.
Exactly.
Exactly. Yeah, so whether you're an individual managing your personal finances or you're the CEO of a major corporation, like Disney, understanding these basic financial concepts is really fundamental.
Yeah, even on a personal level, you're using basic accounting principles when you balance your checkbook or decide whether buying a home makes more sense than renting.
Yeah, absolutely.
It's everywhere, right?
It is, yeah. So for larger organizations, investors want to know if Disney is generating profits and if they can expect a return on their investment. Similarly, a bank considering lending money to Disney needs assurance that they'll be repaid with interest.
And it's not just about looking at what's already happened, but using that information to guide decisions about the future, too.
Absolutely. For example, Disney's management relies on accounting information to inform, really major strategic decisions. Should they acquire another media company?
Right.
Which theme park expansion projects are most likely to be successful?
Interesting.
Are certain product lines profitable enough to continue? These are all questions where accounting data provides those crucial insights.
So, businesses come in all different shapes and sizes. So, how does the way a business is legally structured affect its accounting?
Well, the source material outlines 4 primary types of business organizations, and their structure has some really important implications, particularly concerning legal liability and how they're taxed.
So, let's start with, the simplest structure,
Yeah.
the proprietorship. What is that all about?
So a proprietorship is a business owned by a single individual. They're often smaller enterprises. From a legal standpoint, the business and the owner are considered the same entity,
Okay.
meaning the owner is personally responsible for all the business's debts. However, for accounting purposes, the business is treated as a separate entity from the owner's personal financial affairs. This allows for a clearer picture of the business's financial performance.
Okay. And then next we have partnerships.
Yeah, so a partnership involves 2 or more co-owners, who can be individuals, other corporations, or even other partnerships. A key characteristic is that the partnership's income and losses flow through directly to the partners,
Okay.
who then report this on their individual tax returns. The partnership itself doesn't typically pay income tax. There are also different types of partnerships. In a general partnership, all partners typically share in the business's operational management and liability.
Okay.
Limited liability partnerships, or LLPs, offer some level of protection to the partners from the partnership's debts, though they often require at least one general partner with unlimited liability.
Okay. So that's partnerships. Then we have the LLC.
Right, the limited liability company. So the LLC offers a significant advantage in terms of liability. The owners, who are called members, generally have limited liability, meaning their personal assets are typically protected from the company's debts,
Okay.
similar to the protection offered by a corporation. At the same time, like a partnership, the profits of an LLC usually flow through to the members for tax purposes,
Right.
potentially avoiding the double taxation that corporations can face.
Right.
And that leads us to corporations, which are, arguably the most intricate structure.
Yeah. Those always seem a little bit more complicated.
They are, yeah.
So what's the deal with corporations?
So corporations are owned by stockholders.
Hmm.
They hold shares representing their ownership. And a major benefit of the corporate structure, especially for larger companies, is the ability to raise substantial capital by selling stock to the public. A corporation is legally considered a separate entity from its owners, essentially a distinct legal person. This separation provides stockholders with limited liability. They're generally not personally responsible for the corporation's debts.
Okay.
However, a significant consideration for corporations is double taxation.
Mm-hmm.
The corporation itself pays corporate income taxes on its profits.
Mm.
And then when it distributes some of those profits to shareholders as dividends, those dividends are taxed again at the individual shareholder level.
Oh, I see.
Many well-known companies such as Disney, Amazon, and Apple operate as corporations.
Okay, so we've got these different structures, but it sounds like there needs to be a consistent set of rules for how they do their accounting.
Exactly. There's a whole conceptual foundation that underpins accounting practices. And this is aimed at providing information that's useful for making sound financial decisions. Exhibit 1 to 3 in the chapter outlines these characteristics, and they're what we call fundamental qualitative characteristics.
Mm-hmm.
And these make financial information useful. So we have relevance, meaning the information must be capable of making a difference in a decision, and faithful representation, meaning the information must be complete, neutral, and free from material error.
Okay.
And then we have what are called enhancing qualitative characteristics, and they improve the usefulness of financial information.
Okay.
So we have comparability, allowing users to identify similarities and differences between different entities. Verifiability, meaning independent observers can reach similar conclusions. Timeliness, ensuring information is available in time to influence decisions. And then finally, understandability, meaning that information is presented clearly and concisely. And then there's also a cost constraint, which means that the benefits of providing financial information should outweigh the costs of doing so.
Okay, so let's talk about some of these specific underlying concepts and principles. The first one is the entity assumption. What's that all about?
Okay, so the entity assumption is a really important cornerstone of accounting. It states that a business is treated as a separate economic unit, distinct from its owners and any other business entities. We need to draw a very clear line in the sand. So think about Robert Iger, the CEO of Disney. His personal financial transactions and assets are entirely separate from Disney's financial transactions and assets.
Makes sense.
Similarly, within a large organization like Disney, the financial performance of their media networks division is accounted for separately from the performance of, say, their parks and resorts division.
Got it.
So this allows management and external stakeholders to evaluate the performance of each distinct part of the business.
Yeah, I mean, you wouldn't want to blur the lines between your personal finances and the finances of your business if you run like a small shop or something.
Precisely. So the next important concept is the continuity or going concern assumption.
Okay, and what does that imply?
So it sounds like it has to do with how long a business is expected to last, right?
Yeah, exactly.
So the going concern assumption states that we assume a business will continue to operate for a long enough period to realize its assets and settle its obligations in the normal course of business. In other words, we assume the business will continue to be a going concern rather than a quitting concern.
Okay.
If a business were considered a quitting concern, meaning it was expected to liquidate its assets, then those assets would be valued at their liquidation value, which is the amount they could be sold for quickly, which might be significantly different from their value in ongoing operations. The going concern assumption is the standard basis for accounting unless there's clear evidence to the contrary.
Then we have the historical cost principle. This one's always seemed kind of weird to me. Why cost? Why not current value?
So the historical cost principle dictates that assets should be recorded on the financial statements at their original cost on the date they were acquired. This cost includes the cash paid plus the fair value of any non-cash consideration given in the exchange. Let's go back to Disney purchasing a new studio building. Even if they managed to negotiate a great deal and pay less than the market value, or if a later appraisal suggests the building is worth significantly more, they would initially record it on their books at the actual price they paid.
And that original cost figure stays there,
Right.
even if, like, the market value of that asset goes up or down significantly over time.
Generally, yes. The rationale behind this principle is that historical cost is considered a verifiable and relatively objective measure. It's based on a past transaction that actually occurred. So even if that Disney building appreciates substantially in value over the years, they typically wouldn't increase its recorded value on their balance sheet until they actually sell the building. At that point, the difference between the selling price and the historical cost would be recognized as a gain or loss. It's important to note, however, that accounting standards are evolving, and there's a gradual move towards incorporating more fair value measurements, which reflect the current market value of certain assets and liabilities.
Okay.
Also, International Financial Reporting Standards, or IFRS, used in many parts of the world, generally permit more assets to be reported at fair value compared to U.S. generally accepted accounting principles, or GAAP.
Finally, there's the stable monetary unit assumption, and this has to do with, like, the value of the currency that we're using, right?
Exactly. In the United States, we use the U.S. dollar. The stable monetary unit assumption says that in preparing financial statements, we assume that the dollar's purchasing power remains relatively stable over time, and therefore we generally don't adjust the financial figures for the effects of inflation.
Okay.
This allows us to compare financial information from different periods as if the value of the dollar hasn't changed significantly. While we all know that the purchasing power of a dollar does fluctuate due to inflation, in countries with relatively moderate inflation, like the U.S. has experienced for much of the recent past, this assumption is often considered reasonable for the purpose of comparing financial data from one year to the next. It's worth noting that for very small entities, there's even a simplified reporting framework called FRFSME, which places even greater emphasis on historical cost accounting than full GAAP.
Okay, so these are like the fundamental principles that guide how accounting is done. Now, how do they all come together to give us a picture of, like, a company's overall financial well-being?
Well, they all ultimately feed into the accounting equation, which is the bedrock of the balance sheet and in many ways all the financial statements. And it's a deceptively simple but incredibly powerful equation. Assets equals liabilities plus equity. This equation must always balance.
Okay, let's break that down. What exactly are assets?
So assets are a company's economic resources that are expected to provide future economic benefit.
Okay.
Think about what Disney owns that will help them generate revenue in the future. This includes their cash on hand, the money owed to them by customers who bought advertising or park tickets on credit, accounts receivable, the merchandise they have in their stores ready to be sold, inventory, and their long-term assets, like their theme park attractions, studio buildings, and production equipment.
And what about liabilities? What are those?
Liabilities are often described as outsider claims on companies' assets. These are the debts or obligations that the company owes to individuals or entities outside the business. It's creditors. For example, if Disney borrows money from a bank to finance the construction of a new hotel, that loan is a liability. They have a legal obligation to repay that borrowed amount, which represents a claim against their assets.
Okay, and then finally equity. So that's like the owner's stake in the company, right?
Exactly. Equity, which is also sometimes referred to as capital, owner's equity for sole proprietorships and partnerships, or stockholders' equity for corporations, represents the insider claims on the company's assets, the owner's residual interest in the company after deducting liabilities. So for Disney, as a corporation, stockholders' equity represents the stockholders' ownership stake in the company's net assets, which is assets minus liabilities. The accounting equation, assets equals liabilities plus equity, always has to balance through the financial statements. There are 4 primary financial statements that provide a comprehensive overview of a company's financial performance and position. And Exhibit 1 to 6 in the chapter illustrates how these statements connect, which is a really key aspect to understand.
Let's start with the income statement. What information does that provide?
So the income statement, sometimes also called the statement of operations or the profit and loss or P&L statement, reports a company's revenues and expenses over a specific period of time, such as a month, a quarter, or a full year. The main goal of the income statement is to determine the company's net income, which is its profit, or net loss if expenses exceed revenues. For example, Disney's consolidated statements of income provide information for their fiscal year, which, as noted in the chapter, ends on the Saturday closest to September 30th. This statement shows their total revenues generated from their various business segments, like theme park admissions, movie ticket sales, merchandise revenues, and then it subtracts all the expenses incurred in generating those revenues, such as the cost of goods sold, employee salaries, marketing expenses, and depreciation, to arrive at their net income for that period. It's important to understand the concept of a fiscal year, a 52-week or sometimes 53-week period that a company uses for reporting its financial performance. Disney's choice to end their fiscal year in late September often aligns with a natural low point in their operating cycle, allowing for a cleaner cutoff for accounting purposes.
Okay, so the income statement tells us about a company's profitability over a period. What about the statement of retained earnings?
So the statement of retained earnings shows how a company's accumulated profits, which have not been distributed to shareholders as dividends, have changed over a specific period.
Okay.
Retained earnings represent the portion of a company's net income that it has kept and reinvested in the business over time. The statement typically starts with the beginning balance of retained earnings at the start of the period, adds the net income earned during the period, which comes directly from the income statement, and then subtracts any dividends that were paid out to shareholders during that period to arrive at the ending balance of retained earnings at the end of the period.
Okay.
This ending balance of retained earnings then flows directly into the equity section of the company's balance sheet.
So the income statement feeds into the statement of retained earnings, and then we have the balance sheet. What does the balance sheet tell us?
So the balance sheet, also known as the statement of financial position, provides a snapshot of a company's assets, liabilities, and equity at a specific point in time. Unlike the income statement and the statement of retained earnings, which cover a period of time, the balance sheet is like a photograph of the company's financial standing at a particular date. It directly reflects the accounting equation in action. Assets equals liabilities plus equity. Assets are typically listed in order of their liquidity, how easily and quickly they can be converted into cash. Liabilities are usually listed in order of their maturity, how soon they need to be paid. Both assets and liabilities are often categorized as either current, expected to be converted to cash or paid within 1 year, or the company's operating cycle, whichever is longer, or long-term, all other assets and liabilities.
Okay.
For example, on Disney's balance sheet, current assets would include things like cash and cash equivalents, accounts receivable, and inventories, while long-term assets would include their property, plant, and equipment, such as their theme parks and film studios. Similarly, their current liabilities would include things like accounts payable and the current portion of their long-term debt, while long-term liabilities would include the remaining balance of those long-term borrowings.
Okay.
Importantly, U.S. GAAP requires companies to clearly separate the portion of long-term debt that is due within the next year and report it as a current liability.
And the fourth key financial statement is the statement of cash flows. So this one tracks, like, the actual cash coming in and going out.
Exactly. The statement of cash flows reports all the cash inflows, cash coming into the company, and cash outflows, cash going out, over a specific period. It differs from the income statement, which can include non-cash items like depreciation. The statement of cash flows categorizes these cash flows into three main types of activities. Operating activities, which result from the normal day-to-day running of the business, think cash received from customers for movie tickets or merchandise, and cash paid to suppliers and employees. Investing activities, which involve the purchase and sale of long-term assets, such as property, plant, and equipment. For Disney, this would include things like investing in new theme park rides or acquiring another company. And then financing activities, which relate to how the company raises capital and returns it to investors, such as borrowing money, repaying debt, issuing stock, and paying dividends. On the statement, cash inflows are usually shown as positive amounts, while cash outflows are typically shown as negative amounts, often indicated in parentheses.
Okay.
It's really insightful to look at the relationship between net income reported on the income statement and the cash flow from operating activities. For many established companies like Disney in 2016, you might see that the cash flow from operations is actually higher than the net income. This can happen because of non-cash expenses like depreciation, which are deducted in calculating net income but don't involve an actual outflow of cash. The ending cash balance reported on the statement of cash flows for a specific period must then reconcile with the cash balance reported on the balance sheet at the end of that same period, providing another crucial link between the financial statements.
So it sounds like these four financial statements are all interconnected pieces of a larger puzzle. You really need to look at all of them together to get the full picture of a company's financial health.
Precisely. The net income calculated on the income statement is a key component in the statement of retained earnings. The ending retained earnings balance is then reported in the stockholders' equity section of the balance sheet. And the ending cash balance from the statement of cash flows must match the cash balance reported as an asset on the balance sheet. Decision makers analyze all of these statements and the relationships between the various accounts to assess a company's financial performance, its overall financial position, and its ability to generate cash flows. The decision guideline sections you often see in financial accounting resources highlight some of the key things these users look for, such as trends in revenue growth, the level and consistency of profitability, the company's ability to collect money owed to it, receivables, and to pay its own obligations, liabilities, and the sources and uses of its cash.
This has been a really illuminating deep dive into, the fundamentals of financial accounting. And those key financial statements, we've covered a lot of ground, from understanding why it matters to looking at the different statements and how they connect.
Absolutely. We've explored the underlying accounting concepts and principles, the fundamental accounting equation, the purpose and interrelationship of those four main financial statements, and how these tools provide a crucial lens for understanding a company's financial story. Hopefully, this has given you a valuable shortcut to grasping these essential concepts.
So as you encounter news about companies, or even as you're thinking about your own financial decisions, keep these foundational principles in mind. Now that you have this basic understanding, what single piece of information on a company's financial statements do you think would be most telling, and why? That's something for everyone to think about. And who knows, maybe our next deep dive, we could explore specific financial statements or particular accounting principles in even greater detail. We'd be interested to hear what aspects you'd like us to delve into next.